Hello, all. Lovely to have you here on a Saturday morning. Hope you all had a sumptuous breakfast. Today we have Mr. Ganesh, Associate Vice President, Portfolio Management Services, heading our presentation on Solitaire. In this webinar, we would be focusing on how does Solitaire deliver value, how does Solitaire an all-weather product, our investment philosophy, our investment checklist, risk management with Solitaire, Portfolio Quants, and definitely a very enlightening Q&A session. So Ganesh will take over the baton right now. Thank you.
Thank you, Tarun. Uh, Good morning, everyone. Thank you for joining us today. I know it's not easy coming on a Saturday morning, sitting in front of the computer, looking at a bunch of slides. But then I promise to make this a little bit worthwhile for your time. So when we ideated Solitaire, okay, now what you see on screen is a celebrating 3 years of Solitaire. I mean, the slide that we created for celebrating 3 years, which we did last year, right? August last year. So it's been, it would be close to four, it would be four, we would be completing 4 years by the end of August this year. And we've pretty much, or 90-95% done what we had initially intended to create with Solitaire. And sometimes we even outperformed or rather surprised ourselves when it comes to delivering on what we thought we could deliver. So with that in context, Solitaire, we started off with looking at we wanted a product which was scalable in nature, which can appeal to a wide set of investors and also a wide set of goals for multiple set of investors who had various goals in lives, right? You'll we all think about doing something and reaching somewhere, but then some or more often than not, we try to take a path which doesn't seem very aligned to our philosophy. Solitaire doesn't try to do all that. It is very, very simple in nature, but there's a lot of work behind what goes into your Solitaire portfolio, and that is what we will be looking at in this presentation. So our investment philosophy to start with, right? So this is our overall team's philosophy. That is overall, I thought as a firm runs on this philosophy, which is long-term focus, right? We are not momentum players. We are not in for the short term. We are never in for something which runs on speculation or liquidity. We are more towards the long term, where you can sustainably make money or create your wealth chest over a period of 3 to 5 years. And all this is possible only if we stay away from the crowd, right? So, which is what non-consensus investing pretty much means, which actually says that you don't really need to follow the crowd or follow the herd to make money. So what we do is we stay away from the overall noise and overall consensus and make money in our own way, because our investing is for people who believe that a certain path that we have to take. It doesn't need to be a very it doesn't need to be a hard terrain. It doesn't need to be something which is very ambitious, but it is something which can be sustainably wealth creating over a good period of time. So that is what we ultimately look at doing over the long term, and it's bottom up investing. And you'll have to look at non-consensus investing and bottom up investing together. So when we say bottom up, what we mean to say is we go idea specific, right? When we don't go from top to down, we go from bottom to up, which means that we go idea specific. So even in markets where even when the broader markets tend to be overvalued or tend to be going nowhere, right? We are on the lookout for ideas which can perform well over the next 3 to 5 years or in the medium term. Because what we believe is if there is a bottom up approach, your flexibility becomes better, right? You tend to get better with your flexibility in terms of ideas. So your portfolio can be customized to that extent so that your the returns and the experience for multiple sets of investors is homogeneous, because investors are going to come in at different points of time. They're not going to come in at the same time. So when you actually come in late or early, you shouldn't be penalized for your early entry or late entry. So those cases, you'll have to make sure that all our investors have a very homogeneous experience. So your strategy will be the same that Solitaire runs, but your stocks, or your ideas might change depending on the date of entry, because inherent philosophy is bottom up, right? So we are idea specific, and we look at an idea that is conducive in nature at that point of time when you actually join in with us. And there's a high focus on risk management. The whole firm runs on this philosophy because capital protection becomes a very, very important aspect for all our investors, right? Our intention is not to do or give you the highest returns, or you give you the best returns by taking the highest amount of risks. No, we have a very, very good amount of focus on risk management, and we have managed to perform very well in while keeping the risk management in check. So that is what Solitaire or ithought is all about. And if you go on to the specifics of Solitaire, right, the USP of Solitaire, as I was talking about in the previous slide, the customization of your portfolio is one of our main USPs, right? So let us say you come today. The market context is not the same as if you had come into our overall universe maybe 1 year back, or even 6 months back, or even 3 months back, right? And a lot has actually changed. And markets keep getting more efficient by the day, and what the market is yesterday is not the same as it is today. So we need to make sure that your investing is contextual. So how to do that is to create a customized portfolio for you when you join in with us. So that way, like I had mentioned in one of the previous points, it gives all our investors a very, very homogeneous experience, because a lot of investors, they keep saying, people had come in 2020, they would have made a lot more money. But if they had, let's say, come in at the market peak, which is now, or maybe September 2021, right, they would have made relatively lesser returns. So, though there might be some truth to that, our intention is to make sure that the experience of those investors who come to us at any points of time, the experience is homogeneous, right? The experience is similar across our investors. That is our intention, and that is why we chose this model of customizing your portfolio when you enter. So you get your portfolio. So how our team works is we have a robust process, right? So let's say you give us money today, you open your account with us today. What happens is on the next day, we have a portfolio set up, or rather on the day that you on board with us, right? Once the money comes into the account, what happens is we customize your portfolio according to your entry date. On that day, this portfolio is something that Solitaire would approve of. That is how the decision is taken, and decisions are taken on a very, very pointed basis, even when you add money to your portfolio tomorrow. So that is how customization works in our universe. And businesses of the future, as in, obviously, if we are not going to be looking into businesses which are hot or glamorous today. We are going to be looking at businesses which are in their very critical phase. Probably business which have put in a lot of capex and waiting for some operating leverage to kick in the next couple of years. That is where your growth comes in from. So we are looking at typically investing into businesses which are of that nature, and not businesses which are kind of attracting liquidity today, because chances are that those kind of businesses are already overvalued, right? There's no equilibrium usually in the market. It's either overvalued or undervalued. So you try to somewhere be in the middle so that you make an adequate amount of decent amount of returns. That is our intention. And opportunistic buying, right? So when we say opportunistic buying, it's very simple that we do. So you'll have to look at a customization of the portfolio and this point together, right? When we say opportunistic buying, or when we say customization, what we mean is every time there is an idea, it does not. Every time an idea comes up, it's not going to be available to all our investors, because our investors might have cash at that point of time. Our investors might have not joined us at that point of time. So how do we ensure that we pick out these opportunities, because opportunities are not going to be homogeneous, like I said, or but the experience can be homogeneous, right? So we keep hunting for opportunities, and even if we are not able to capture certain opportunities to one investor, it is in our endeavor to look at further opportunities to get in, or to make sure that our other investors who can chip in cash at later points of time, or who join us later, will also be able to participate in the Solitaire experience. So we keep hunting for opportunities, stock level, idea level, and this idea maintenance goes a long way, right? So idea generation is one thing, but idea maintenance is a whole other part, right? So once you generate an idea and comes into your portfolio, it is not necessary that, it is you can't just wave your hands off and say, I'm not going to be looking at that idea anymore as long as it's in the portfolio. The idea maintenance takes a lot of efforts from our research team. They attend AGMs, they attend con calls, they make sure that this stock is worth holding in your portfolio and not just buying, right? Once we buy, it's important to know why we need to hold it further. And also, even if the price becomes more conducive for a later investor who joins us, at a later date, at that point of time, we would want to buy that idea for that customer as well to make sure that he also participates in the overall idea. So that is the whole point of, you know, the opportunistic buying point. So if you look at all this, right, if I do customization of your portfolio and invest into businesses of the future, what we need to do is have a low churn, because our intention, like I said, it's not going to be momentum driven. It is not going to be on the short term. It is not going to be towards speculation. It's definitely going towards long term sustainable wealth creation. And for that, a low churn strategy is something that would work very well. And that is exactly what Solitaire follows. Okay, so now we get into a little bit deeper and goes into a great investment, right? So if you look at a great investment, what does it typically have? People who would have made money on momentum, on liquidity, all that, putting those things aside, right? If you look at ideas which have actually delivered returns or which have delivered sustainable wealth over a long period of time, you can see that this is a combination of just these two, right? These are strong fundamentals, and when you buy them only at attractive valuations, these strong fundamentals will contribute to price. Because just having strong fundamentals and buying them at any price is not something that we actively advocate, because quality comes with a price, definitely. There's no doubt about it. But then only when a specific asset undergoes a specific a weakness in a situation where it's facing weakness, right, in terms of valuation, that is the time we get into it, because the asset is seen to be undervalued because it is going through a temporary bad phase. That is when you get to buy your assets cheap, and that is when you get in. So quality, even if it comes at any price, we need to be very, very careful about how much we pay for the quality, because even the best companies in the world, which are still doing well financially, right? Even when people invest into these companies at wrong points of time, they've hardly made any money over the long term, despite being in the stock for a long term, maybe. And when I say long term, it means around 10 to 12 years, right? That's a significant period of your life which you contribute and would want to grow your wealth by. So when you have those kind of when you have that kind of an approach, right? When you have an approach to stay into the markets for 10 to 12 years, all you need to do is find a stock which has good fundamentals. But not only that, you'll have to make sure that the stock that you're buying is at the right valuations when you buy. So this becomes increasingly important, primarily because uh, your pricing, right, or any time correction that happens, it usually elongates and make and ensures that the time correction reverses at a very, very later point in time, because uh, you wouldn't have that kind of a stock doing well at all points of time. Because if you buy them at a high PE, right, the chances are that you will make good amount of money, decent amount of money, even over the long term, is very, very minimal. So let's go into what strong fundamentals ideally mean, right? So the first thing that Solitaire looks at is a good corporate governance metric, right? So corporate governance is something that is not quantitative in nature. It is very qualitative, right? So it comes with how a management responds, how a specific company responds to its small shareholders, or how it has behaved in past, right, with respect to its the expectations that the markets, and the way it has actually achieved or not achieved these expectations, and has it walked the talk in the past, or like, so multiple things like these actually give you a good sense of how the corporate governance looks, how its statutory obligations have been met in the past. So all these things are very, very, though you can put certain things on metrics, these are very, very qualitative in nature, and these kind of metrics need to be very carefully assessed. So it takes a good amount of time. So when you have an advisor who has experience of looking at all these kinds of managements in the past, you tend to develop a quality check, right, in your mind itself. When you have a fund management team which is as experienced as ours, you tend to form this quality check in your mind, and it's very, very the assessment is very qualitative in nature, so it cannot be really put on paper. So you would need your advisor to let you know whether this, or you would need a strong advisor on your side to ensure that you get into companies with a strong corporate governance structure. And when you say leadership, right, this comes along with the corporate governance. So you can see that leadership teams, which have been in the past, who've been executing targets from point to point, from strength to strength, you can see that these companies which are consistent in nature. So these are typically managements which are conservative in their estimates because they rarely care for market attention, right? They're more towards growing their businesses. And flourishing in their business and rarely care about markets, the public markets as such. Though it is important to them, it's their own company's financial growth which is more important to them, right? So when you have these companies which are conservative and they give out their estimates to the public market, but still outperform, these are very, very strong leadership teams which have a track record of execution, right? So you can see that they promise and under promise and out perform. So these are the kind of managements that we typically look at when we have your when we customize your Solitaire portfolio. And once we do this, right, we get into something called industry leadership. So why we ensure industry leadership is very simple. In any industry, the top three industry leaders, they take away a huge chunk of the profits of the industry, maybe a 40 to 50%. So let's say there are 30 companies in a specific industry, right? Or around two to three, I mean, the top three industry leaders of that specific industry take away around 40 to 50% of the overall profits of the industry. That is how economics works, right? So when we pick out our portfolio stocks, our portfolio universe, we ensure that these are industry leaders and they're typically on the top three, right? So we ensure that they have good cash flows. What do you do with when you ensure that they have industry leadership is that you know that they have pricing power and you know that they have withstood the test of time. They've been through different market scenarios, and that's when only then you can attain that industry leadership, right? So you get a company which is very well seasoned in its own business. So when we do that, we kind of ensure that we are in a very, very strong company in terms of business performance. Once that is achieved, once that is ticked off the list, what we look at is high ROCE. They definitely have to deliver good ROCE metrics, and this is on the expected levels, right? It can be a company which is not been, which is just coming out of a cocoon after a long time, right? It will deliver high return metrics on its on the cost of equity is something that we would expect out of our Solitaire portfolio and zero or low leverage. So when you have a company which is an industry leader and with high return metrics, and also which is the company which is conservative in terms of financial management, it's a no-brainer, right? So that is what Solitaire achieves to do. When you have a company which doesn't have to think about paying off external borrowings before paying off its shareholders, right? You get a company which is robust with cash flows and with a very, very solid balance sheet. And once all this is done, once one, two, three, four, five is ticked off, as we had said, the strong fundamentals part is ticked off. What comes later is the reasonable valuation part, right? So once you tick off the fundamental part, you need to definitely ensure that your valuation part is also ticked off because we have seen investors staying into very, very strong stocks, fundamentally strong stocks, but when they get into it at abnormal valuations, what happens is the timing, or rather the time required to stay in the stock to make or to get a payback or to get the payback on what they expect on a specific idea, it takes a very, 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 very long time. So that time correction is something that we would not need to go through when we invest. So what we typically ensure is that you buy them at reasonable valuations because more often than not, quality, like I said, it comes with a price. So it is not exactly every time that you get a very solid stock at a very cheap valuation, right? You can't get it at very, very cheap valuation. So what we need to ensure that we somewhere stay in the middle so that our valuations are reasonable, so that we catch the good part of both sides, right? So you don't need to actually wait for a very cheap valuation to come or buy it at a very high price. You can buy it at a reasonable valuation, which your valuation metrics suggest. And let me take you through a few portfolio quants, the latest portfolio quants that Solitaire has, which kind of substantiates what we had discussed in the previous two slides. The portfolio of market leaders. So if you look at our portfolio, we have the data as of 31st December 2022, where you can see that our position in the top market leaders in the first position, which are in the respective industries, right? You can see 73% of the solitaire portfolio is on its top, right? It's on the first position with respect to industry leadership. So when we do this, right, they take a lion's share of the industry profit. When we do that, what we ensure is we are getting a company which is robust in terms of business performance, in terms of cash management, in terms of pricing power. So when we ensure this, what we typically ensure is that this company, so to put it very simply, we need to ensure that this company doesn't go bust, right? In terms of business, in terms of financial management, or anything for that matter, it doesn't go bust. So what we need to do is we need to ensure that your cap. So all this is done to ensure that your capital is well protected, right? So this being one part is something that so even these top market leaders and these industry leaders will go through phases of underperformance in terms of business as well. But then that is when your asset becomes cheaper, right? That is when your asset is undervalued in the overall in the market. But the market leadership is still retained, and you look at an industry which is actually going to do better in the future. And once that comes up, right, once the industry gets better, the best or the direct beneficiary is going to be the market leader of that respective industry. And what you need to do is just buy that asset at a very cheap valuation and wait it out. So that is our intention to do. That is our intention with respect to our Solitaire portfolio. And if you look at our balance sheet, right, this is a very important. So a lot of our investing or a lot of the markets investing, recent investing, right, post 2020, 21, has been towards P&L investing, right? So it was people, or rather, the 2020 had a lower base, and when the growth happened on the P&L, now not a lot of or rather a good amount of market participants did not look at how the balance sheet will the balance sheet be able to sustain this kind of a performance over the long term is something that a lot of the market participants fail to notice. And this is a cycle, right? This usually happens. So a lot of us go towards P&L type of investing, while balance sheet type of investing is something which will ensure sustainability. A P&L looking at a P&L and its growth just on year to year and using that growth to your momentum is something which rarely works for the long term. And more often than not, we try to catch an asset at the wrong time of its cycle. So when you actually put the balance sheet in the forefront with respect to asset valuation, right? It takes in sustainability into the picture and not just a temporary growth. So right, so temporary growth is, as the name suggests, is very temporary, right? It doesn't mean that the asset should be valued at that specific, or rather, it doesn't make sense to value an asset based on just its P&L. So when you look at that, our Solitaire portfolio has 85, close to 84 to 85% of the Solitaire portfolio is are companies without debt, which are net cash. And even in this 16.20%, which we show on the screen right now, is are companies which have very negligible debt. So what you ensure when you do have a portfolio of companies with which have very negligible debt is the dividend payout usually is a little bit higher, right? Because you tend to pay your shareholders better when you don't have any external obligations to pay off. So all these companies also, when there is a high, let's take our current scenario, right? When the inflation is actually now, when the inflation is peaking out, right? When the inflation is going up every day, and when the interest rates are being hiked to control the inflation, you are in a very uh, you're in an environment where the liquidity money supply is being restricted. You have a high interest rate scenario where, and those companies which are highly leveraged at this point of time, right? If they get their business cycle right at one point, then they do well. But then if they do not do well in their respective businesses, they are caught on the long side of leverage, right? So what happens is, even in these kind of scenarios, your solitaire portfolios relatively very robust in terms of balance sheet, because we typically invest into companies which are which are low, or which do not have any leverage in their balance sheets. That is the intention. And we have a very balanced sector composition with respect to our Solitaire portfolio, and this is typically the overall sector composition of the scheme level portfolio as on 31st May 2023. But let's say an investor comes to us today with the required amount for PMS and asks us to open up a Solitaire account for them. At that point of time, the composition can vastly differ, primarily because the current context might not exactly support a composition which you see on screen today. So it will be specifically customized according to the investor's entry date. On risk management. So what we look at with respect to Solitaire is when you compare it to the Nifty 500, right? So you can see that Solitaire typically operates between this 3% to 5% allocation, right? So what we need to do is we need to ensure that there is attribution, right? It doesn't mean that there's no necessity to keep 100 or 200 stocks in your portfolio with them not contributing either on the top or on the bottom, right? So it makes we need to ensure that there is adequate attribution to all the stocks that form part of your portfolio, because that is when you can take your decisions effectively. So if there's a company, or rather if you look at Nifty 500 and it's a split, right, there are 483 companies, right, which is a huge chunk out of the 500 companies which have less than 1% allocation in, or 1% weightage in the overall portfolio. So typically, even if these companies tend to do well or do badly, nothing is going to happen to your portfolio returns, or not much is going to happen to your portfolio returns, because ask for it to these stocks to do absolutely nothing. So what we do in Solitaire is very simple. So we typically operate is between 3 to 5%. Even if you look at 1 to 3%, it will be closer to 3%. It will be primarily maybe 2.7%, 2.8%. So that is where our allocation starts, and we go up to 7%, though we haven't gone yet. So if our conviction becomes a little bit, this is all on cost, right? So when our conviction becomes a little bit enhanced on a specific idea, then we can go up to 7%. But we typically operate between 3 to 5% currently. And these less than 1% stocks are primarily those stocks where the entry is just being made. So no, we might have started buying a position in a specific stock. So we don't buy it all at once, right? How Solitaire typically works is, if we want to get into an idea and we want to buy 3 or 5% in that specific idea, unless the stock is offering a very cheap, unless the valuation of the stock is very favorable at the given point of time, we don't go all in and buy and complete our position. So we buy 1%. So we buy 1%, we buy half a percent at one day based on the market. Let's say there's a market correction, we tend to buy more. And when we need to be aggressive, we tend to get aggressive. So your positions are built over a period of time, and that is what we differ, right? That is where we differ, from the overall market. So where we add customization, right, it can actually add up to a lot in terms of portfolio performance at the end of 3 to 5 years to you. Because any stock that we tend to buy it at lower valuations, when we buy it at 0.5%, 1%, or 2% more in your portfolio at lower valuations, that gets your average cost lesser. And overall, this can contribute to a very good amount of alpha, additional alpha that you can generate on your portfolio in terms of additional contribution. When I say additional contribution, right, so let's say you start off with a Solitaire portfolio today with a 50 lakh initial capital. So tomorrow we would be constantly monitoring your portfolio. We have a separate setup just for that. And when we do that, we tend to spot opportunities more often than not. And when we spot those opportunities, what we do is we pick up the phone and give you a call. At that point of time, if you respond to us maybe with a 5% or a 10% additional capital, what happens is this additional capital goes into those specific 2 or 3 ideas where we would be able to buy maybe 2% or 1 or 2% in each of these ideas, and then this 1 or 2%, right, addition at these prices would ideally help you generate that extra alpha on your portfolio at the end of 3 to 5 years. That is simply how we work, and this it is not usually a product. So what we usually say is we do wealth management within our product setup itself. So it's not just a product sale. There's a lot of wealth management behind your portfolio as well, and your portfolio is getting built over a period of time with your help. So it's a symbiotic nature, a symbiotic relationship in nature. So your contribution is going to help your portfolio, while our research is just going to fuel those. Your contribution is just going to fuel our research and strategy in your Solitaire portfolio. And okay, so like we spoke about in our second slide, right? So it's about great fundamentals and strong valuations, which matter a lot. Similarly, your long-term investment success, right? It's a combination of these two. It's about riding your winners till they reach their maturity in terms of valuation, and selling your losers at the opportune time in terms of fundamentals, right? When you say winners, well, as long as the fundamentals are intact and are in place and are going right, then you ride your winners. But let's say your whatever you considered as winner doesn't actually support in terms of fundamentals in the future, which is why your idea maintenance becomes very, very important. You start off with buying an idea, and tomorrow, let's say the idea doesn't play out or the thesis doesn't play out the way you want it to. What you need to do is you need to make a very, very sharp selling call at that point of time to make sure that your capital is protected. So let us look at a couple of ideas which went right, or which one of them went for right and one of them didn't go so right. But what did we do at that point of time is something that we need to look at. So this is our winner, which is KPIT Tech. So it has even been a 10 bagger for some of our clients, which we were able to buy, at lower valuations for certain clients of ours who joined us in 2020. At that point of time when we bought it, which we bought it around 50, 60. I think we went up to 40 as well. And for those clients, it was a 10 bagger as well. So when we did this, what we had to ensure is that this fundamental, right? So if you look at how we started buying our intended position around in 2020 between 50 and 62. That was our average price at that point of time. You can see that they had a deal when the price was around 89, 90 or close to 100, right? So we tracked this company, and if you look at it at 200 rupees, there's a promoter plus reduction. So what we see is this thesis is playing out the way we wanted to play out, or rather the way we expected. So when that happens, what happens is our conviction goes up in that specific idea, and that helps us even buy the stock at a higher valuation, because valuation is so what we would look at a stock when we look at the valuations is how much it's going to grow in the future, and what it is quoting in terms of the future earnings potential that it possesses. In terms of smaller stocks, it's about how much market share that specific idea can capture. So even when we even bought the KPIT stock for some of our clients at around 200 rupees. For them, it was pretty much been a two bag or a three bag in a very, very short span of time, right? So what gave us the conviction to buy it even at 200 after buying it at 40 or 50? Naturally, it's natural, right? You buy a stock at 40 or 50 rupees and it goes up to 200. You wouldn't think about buying it once again. So that's natural to all of us. But what made us keep buying this stock even at 200 is primarily because the fundamentals kept outperforming our expectation and our thesis. And at one point of time, now we are completely out. At one point of time, when the fair value, or rather, when the market value far exceeds the fair value, that's when you take your complete exit. So the perfect example of how a company's fundamentals matches your thesis, and how you build your position over a period of time, and then you get out at an opportune time. So in this case, right, what we did was we completely monitored the stock with respect to fundamentals and price when and we reduced our exposure at opportune times also. But then the company kept outperforming, and once we are completely out, right, we made a good amount of money for all our investors who joined in at even different points of time. So what we do is, this is what we were talking about when we said homogeneous in nature, right? Even when an investor who had come in and in 2021 of April, at that point of time, even if I had bought it for our investor at 200 rupees and sold it at 650 or 646, we would have still made a three bagger for him primarily. So the experience for that investor would have also been good. But it's in the same stock primarily because our conviction at that point of time was I mean, multiple times more than what we had when we bought it for our clients at 40 or 50. So even when we had the conviction, right, the price was at a throwaway price. When we had the conviction initially in 2020, it was at a throwaway price. So at that point of time, for investors who made money from 2020 till 2021 or 22, right, they would have made good amount of money. But is the experience homogeneous? Yes. So we would have had another idea which for an investor also who came in at 2020 along with KPIT. So it's going to be a box of ideas and not just a single idea that's going to work for you on your portfolio. So it's going to be a mix of multiple optimum ideas which will give you optimal returns, plus one or two winners like KPIT Tech, and definitely it will have a couple of losers as well, as the law of probability suggests. So one such loser is what we are going to talk about on the next slide, which is so this company we started buying at around 200, 230. We bought our intended position, and it went in a good short span of time. It went up to 354, and over there, when at its height, we got into there was a corporate action, right? It was a general meeting, and from the management, which was actually there was a red flag, right? It was actually moving from what it had initially promised to something which was vastly different, and which would take the company in a completely different route. So we found that kind of an activity a little bit uh, not in line with transparency or with respect to high quality, right? The corporate governance, or rather the management, was not too transparent about that specific idea as well, and about that specific corporate action was not very conducive in nature for the future. I mean, it was not very transparent on what the management was going to do at that point of time. So we weren't, we consider that, we still consider those kind of things are very big red flags. As very big red flags, primarily because you don't know what the management is going to do tomorrow. Because it says one thing and it does another thing, it might do the same thing tomorrow, and it might be too late before you try to exit from that company. So we took a very sharp call to exit from that company at around 320, and as you can see, after that, the stock went down. Now it is maybe it's back up. So, but what we typically look at Solitaire is see, even if the stock has gone back up after coming down, right? How many of us would have been able to take that kind of a correction from 350 to 169? That's where it went, right? It's less. I mean, it's corrected more than 60-70%. So when that happens, what do you actually I mean, most of us would not be able to take that kind of a correction in your portfolio. So what we tend to do in Solitaire is try to get out these kind of stocks so that you get a very consistent experience in terms of price. You don't look at big drawdowns in your Solitaire portfolio because it's very well constructed. It's very well bought or very well customized in terms of price. So what we ensure is we weed out these kind of losers and make sure, because you don't typically find out a loser at the initial look, right? Because I mean, all of us can make a mistakes, but it's about how quickly you realize that it is a mistake and get out. So your portfolio is going to be a mix of all this, but overall portfolio's performance or the experience that you will get on a Solitaire portfolio is relatively robust when compared to other products in the market. Because our if you look at our beta also, it's close to 0.75, which is typically not a normal multi-cap portfolios beta. So we we specifically look at those kind of companies which have low volatility, which are lower in volatility. But then we do consider volatility as an opportunity as well. But then if you look at the overall portfolio volatility, it is going to be pretty much on a safe scale. What the portfolio would look like after a few years. Yes, you would have a few big winners like KPIT. You will have multiple optimum performers. Our intention is to make sure that this middle ground is achieved, right? We need to be patient. We need to keep regular checks on business performance and make sure that all your stocks are optimum performers. And out of these optimum performers, there will be a few big winners as well. Our intention or our research or our thesis is going to be towards the middle ground. We're going to look at optimal performers, which will eventually become few big winners like KPIT. So in case of KPIT, it was a little faster than we expected it to be. So you would have stocks like those in your portfolio, but then it is going to be a typical multiple optimum performing portfolio that you get with Solitaire. And obviously, you will find a few losers like the one we saw in the previous slide. So what we need to do is we need to keep a quick or very strong vigil on the fundamentals of the on the fundamental performance of the company, and if they deteriorate at a later point of time, we need to make sure that we take a strong sell call, right? And with respect to fund positioning, it's a moderate risk-taking portfolio where the expectation on returns is close to 700 to 900 basis points over the average Indian inflation rate. So the ithought return setting matrix. Okay, so this is a very interesting chart that we typically to show to all our investors, right? What we generally try to put out from this chart is simple. So because your experience can be different at different points of time when you enter the market. So let's say you had entered the market in 1999. The first year you would have got 66% returns on your portfolio. So your expectations could be set in that way. So I'm going to get 66% every year. No, that's typically how we all think, right? That's how human psychology works. So ultimately, that is how you start off. But then if you look at how the returns have averaged out over a period of even let's say 13 or 14 years, it's a market has done around 13 to 14%. Even in a good, when you started off in a good year in 1999, where you actually made 66% of returns. But you take something like 2000 also, even if you had made you would have made no money for the first 3 years, right? Even in that case, you would have actually averaged out at 11%. So what we intend to say is sane for the long term. Even the entry, even if it is going to, and market has delivered around 11 to 13% over the long term, and the expectations need to be set that way. See, our intention is to make sure that we give you a good experience over the long term, that is 3 to 5 years, and ensure that, and also have a decent set a decent expectation on returns, because markets, though from 2020 the expectations have gone up primarily because markets have been making new highs, and that that expectation needs to be put on paper. And actually what data says is very simple. Markets have done 11 to 10% on an average over a period, over the long term, and our expectations have to be aligned to that. And this is something that we have delivered over a period of close to 4 years right now, and we've done a pretty good job. Whenever the markets have actually corrected, when you look at the 1 year numbers, right, it's very important to see how the gap has been achieved, because you can see that in the last 1 year we are at around 20-21%. How did we achieve this? Is primarily because of our investors who given money at opportune times. And not only the initial, I mean, the initial money is definitely invested into companies which are bottom up in nature, right? Our intention is to invest into companies which are still conducive to invest into, even in periods of market outperformance, or overall market outperformance. But even when we do that, right, we typically invest into companies which are undervalued at that point of time. So our last 1 year performance is a testament to our existing investors who also gave us money, additional money, at periods where asset valuation becomes cheaper. We tend to add, like I had mentioned in one of the previous slides, we tend to add a little bit, 1 or 2% of our existing picks, or a new idea which comes into the research universe, right? It comes into the investment pipe. When we tend to add these kind of 1 or 2% extra during these opportune times when the market gives a correction, so that typically contributes to this additional alpha that you generate over see, these 21%. What we typically look at in terms of expectations is around like I said, 7%, to that is 700 to 900 basis points over the average inflation rate, which is close to 13% to 15% net of fees and charges. So what we have performed is a little bit over and above that. Our expectations, primarily, our process has helped us do that. But in terms of expectations, we will definitely be able to do a very decent job over a long term. And investors who've been with us for a good amount of time are a testament to that, and how they performed is definitely something which is being done not only by us, because they have contributed whenever we have asked for money, and that makes up a good chunk of this performance, right? 50% of the performance has come from our existing investors, and who have contributed at opportune points of time whenever we made our calls, right? Whenever we made our calls, they've been kind enough to make sure that they had the liquidity ready, and they infused capital whenever we asked for. So that's a good amount of this performance has come from that. So this is maybe I'll spend another, maybe I'll just wait for another minute before we move on to the next slide. Okay, thank you. Moving on. And this is our PMS team. So we have a very strong fund management team with Mr. Sham at the top. He is the fund manager for all our PMS products, while we have Mr. Balaji, who is the head of research, Mr. Rohit and Rajat, who co-fund manage the Vriddhi product, and Mr. Niranjan, who is the head of investment strategy. He also looks after the Sphere PMS product, which is a multi-asset product, and these are small cap product, while True Blues are large cap product. So we have a good set of products that cater to a wide range of investors, right? Because your risk appetite is going to be different from another investor's risk appetite. And flowing down, we have a very strong research team of CAs, CFAs, and we do ensure that we have a solid team to run this process, right? It's ultimately going to be public money that we manage at our end. So this public money needs to be managed with some kind of seriousness. So we've built our team in a way that there's a hierarchy to each and every decision that is taken. And obviously, with investment management, we have Mr. Gaurav, and product, we have Ganesh, I mean, I take care of the overall product management with respect to our PMS. So it's a solid team. So what you get in is a solid team which is managing your money, and capital protection is at the forefront with respect to fund management in our philosophy. And we have Mr. Sham, who there's no need to introduce Mr. Sham as well, because he has 3 decades of investing experience in multiple businesses. And so just a brief profile on him. And the key terms to Solitaire is, as the minimum investment that SEBI regulations suggest is 50 lakhs, and the S&P BSE 500 TRI is the benchmark. But we do have an exit load for the first 3 years, which goes as first year. You have, if you want to get out within the first year, it's 3%, 2% second year, and 1% for the third year. It is nil after 3 years, and it's a fixed fee model, right? We charge on a 1.5% per annum on the daily average value of your portfolio, which is charged on a quarterly basis. So this is a per annum charge, which is charged on a quarterly basis, basically. So we've come to the end of the presentation. So if any of you have any questions, we can definitely take it. So you can just type in your questions in the chat box, and I'll be happy to answer them. Thank you. Thank you, Mr. Jayakumar. Thank you for. So any questions, you can type them out in the chat box. Question from Mr. Srinivasan. Yes, let me go back to the slide and then explain this to you once again. Yes. So what we typically have seen in this slide is our allocation in our so if you look at Solitaire's allocation in specific stocks, so there are 36 stocks in the Solitaire portfolio, which was this data was taken as of 31st December 2022. The latest data can be shared by one of our representatives. You can just reach out to us so that we'll share it with you, but it will typically remain in a similar range. This is just to represent how the risk management of Solitaire works. So if you take that into consideration, right, if you look at the number of stocks, which is 36, and the number of stocks which have an allocation of between 3% to 5% in the overall portfolio, right? These are around 15 stocks. And let's say For 1% to 3%, it is around 16 stocks. So these are typically Solitaire's investment allocation is mostly between 3% to 5%. We start off at 3% and go up to 5%, right? So these less than 1% in terms of Solitaire, which is these five stocks, are typically stocks which are just entering your portfolio today. So let us say we want to buy a position in a specific stock today. We won't go ahead and buy this 3%. So let us say we want to buy 3% of the stock, which is our intended allocation as per our internal decision, right? So we want to buy this 3%, but we won't buy this 3% straight away because the price is not going to be conducive at all points of time. It's not going to be the valuation is not going to be favorable at all points of time. So we tend to buy it at we tend to buy it slowly. We maybe will start with the 0.5% position or 1% position and slowly build whenever the price softens, right? So that is when it reaches its intended allocation of 3%. So if there are stocks which already are at good valuations, favorable valuations, and we want to buy 3% of it, we go straight away and buy them. But let's say it is not. We will, because we don't really know how the market valuation works, right? Because we don't control it. We can control only what is controllable at our end, which is buying it at the right price. So when we want to buy it at the right price, we buy slowly, we buy gradually. So these are those stocks which are ideally coming into your portfolio or going out. So even when we sell, right, we sell on a very, very pointed basis because we don't, if we sell it, we should not be, let's say we are selling a small cap, we should not be moving the market. So we tend to sell slowly all the while making sure that you get a good price out of each bunch of sales. So we have an existing position of 5% in a stock which has actually grown from 3 portfolio. So when you compare this kind of allocation to the Nifty 500, right, it is very, very skewed. That is your top 16, or in this case, right, top six stocks make up a very good chunk of the overall portfolio. So even if you take the 1 to 3% of the Nifty 500, it constitutes a total of 17 stocks, which make up the overall 500 Nifty 500 portfolio, which predominantly make all the movement. So if Nifty 500 moves up or moves down, it is predominantly going to be because of one of these stocks, which are between 5 to 7% allocation or 3 to 5% allocation mostly, right? So you're typically looking at a very, very skewed portfolio where the attribution for those stocks, which have less than 1% in the portfolio, which is 483 stocks, right? Which is more than 90%. 90. So when those kind of skewed allocation happens, right? Your attribution becomes very, very difficult. What can you actually, if there's a stock which has a very, very small position in the portfolio, even if it runs up 3x or 4x, the effect that it is going to have on your overall portfolio is going to be very, very minimal. So in terms of attribution, also in terms of risk management, also it needs to be adequate. You need to make sure that your portfolio is optimal in nature and stocks should not just exist in your portfolio just for the sake of it. That is our intention behind this slide and how we are working on how we work versus the Nifty 500, which is predominantly a good sort of good representation of corporate India, which are, I mean, listed corporate India, that is. Hope that answered your questions, sir. Okay, question from Mr. Ramesh Kumar. How the sector allocation or weightage will be done for individual portfolio in different timeline? So it's a sum total of all that we had discussed in the slides. So basically, we are sector agnostic in the first place, right? We are not specifically inclined to a specific sector or anything. So because our approach is bottom up. So what happens is when an individual comes to us tomorrow, they won't typically have the same portfolio composition that we had showed in one of the slides, but that was just more of a complete scheme level portfolio allocation that we had showed. But the idea was to show that we are into different sectors and we are not dependent on a specific sector for our we spoke in this slide also, right? Portfolio attribution is very, very important. We ensure that the attribution to your returns need to be coming from a good amount of diversified sectors and not just from one sector. So that is how the sectoral allocation happens. Though we are not inclined to a specific sector, like I said, we are sector agnostic. It will be done based on the entry point of each investor. So what we have is the pipeline of stocks that we are looking at when they when you onboard with us as an investor at one point of time. At that point of time, whatever the portfolio allocation that is being suggested to you by the fund management team will be given to you. So your weightage or sectoral allocation will change depending on that. Hope that answered your question, sir. Uh, oh, thank you, sir. Thank you, Srinivasan, sir. Thank you. And what is the exit strategy, even in particular stock perform well over long period? So exit strategy, like we had mentioned, it's either if the fundamentals deteriorate, right? If the fundamentals deteriorate and with capital protection in mind, right? With which comes at the forefront before anything else. When in terms of fundamentals, if they're going a little backward, or if there are red flags in terms of management, in terms of business performance, then we take the exit strategy very, very sharply. We need to make sure that we get out of that specific idea very quickly for all our clients. So in that kind of cases, the exit strategy will be very, very sharp. So even if the particular stock performs well over a long period of time, market generally doesn't give an equilibrium price, right? It is either overvalued or undervalued. So there's no equilibrium usually in the market. When the market tends to reward a specific idea, it tends to reward it beyond its fair value. That's what usually happens. So we usually wait for this overvaluation to happen in a specific stock and then quit from that stock. So when even if the overall market looks at it, or rather if it has gone up, let us assume, right, in a specific case where it has gone up 3x or 4x in 1 year, doesn't mean that it is still overvalued at that point of time. It is just that it has gone up 4x from your buying price. It doesn't mean that it is overvalued, because we need to look at markets from a future point of view, right? If valuation is always from a future point of view and not from a historical point of view. We need to look at how valuations look in terms of the growth that is impending, that is going to come for the stock in the future, right? So that is not something which is historical in nature. So we assess a specific stock's valuation point at that specific time based on what it has to offer in the future, in the next 2 3 years. So if in the next 2 3 years we believe that this growth or this valuations will this kind of will be supported by that kind of a growth, then we will hold on, right? Because the valuations in terms of with respect to our valuation tools, if that is fair, then we will still hold on. But if the valuation tools suggest that it is completely overvalued, it is very overvalued with respect to the growth it is going to offer in the future, then we will take an exit from that specific idea, sir. So these are the two things that we typically look at when exiting a specific an idea, sir. Hope that answered your question, sir. Sorry. Thank you, sir. Any other questions? Please type them out on the chat box and I'll be happy to answer them. Thank you. Tarun, if there are no other questions, we'll close it. We will just give 1 or 2 minutes before we close it. What do you think?
Sure, sir. Yes.
Yes, Tarun, I think we can close it if there are no further questions.
Thank you, Mr. Ganesh, and thank you all for attending this webinar. For any more queries or questions, you can get in touch with us through email or phone. I'll be typing out the email ID and also the phone number on the chat board. Thank you.
It's on
Have a
the
nice day.
screen as well, Tarun. If you take a look at the screen also, you can look at our email ID or our contact number, and you can take note and let us know. One of our representatives will get in touch with you. Thank you. Thank you, Tarun. You can anyway type them out in the chat box as well so that people, so that our participants will get to know. Yeah. Thank you, Tarun. Thank you all for joining us today, and it was great having you here. See you. Thank you.